A balance sheet is one of the most important financial statements for businesses and individuals managing their finances. It provides a snapshot of financial health by listing assets, liabilities, and equity. However, for beginners, reading a balance sheet can feel overwhelming. To make it easier, here are 10 ways to understand a balance sheet effectively. 1. Know the basic formula. A balance sheet follows a simple equation. Assets equals liabilities plus equity. This equation must always balance. Understanding this formula helps you see how a company's resources, assets, are funded by debts, liabilities, and ownership, equity. 2. Identify the assets section. Assets represent what a company owns and are usually categorized as current assets, cash, accounts receivable, and inventory, convertible into cash within a year, fixed assets, long-term assets like property, equipment, and land. Analyzing assets helps determine a company's ability to generate revenue and manage cash flow. 3. Understand liabilities. Liabilities are financial obligations or debts. They are divided into current liabilities, short-term debts like accounts payable, wages, and taxes due within a year, long-term liabilities, loans and bonds payable over an extended period. Comparing liabilities to assets helps assess a company's financial stability. 4. Analyze equity. Equity represents the owner's claim after all liabilities are paid. It includes owner's equity, for sole proprietors, shareholders' equity, for corporations. Equity is an indicator of a company's long-term value and financial health. A growing equity balance is a positive sign. 5. Check for balance in the equation. The total of assets must always equal the sum of liabilities and equity. If they don't match, there might be accounting errors. Ensuring the equation balances confirms the accuracy of financial records. 6. Compare current assets to current liabilities. A useful ratio to check is the current ratio. Current ratio equals current assets divided by current liabilities. A ratio above 1 means the company has enough assets to cover short-term obligations, indicating good financial health. 7. Look at trends over time. Instead of analyzing just one balance sheet, compare several reports over time. This helps track trends in assets, liabilities, and equity. For example, if liabilities are increasing while assets remain the same, it could signal financial risk. 8. Evaluate debt levels. A company's debt-to-equity ratio helps measure financial risk. Debt-to-equity ratio equals total liabilities divided by equity. A high ratio suggests reliance on borrowed money, which could be risky. A lower ratio indicates a company is less dependent on debt. 9. Examine cash reserves. Checking the cash balance in the assets section shows how much liquidity a business has. If cash is too low, the company might struggle to cover expenses. A healthy cash balance is crucial for financial security. 10. Read the notes and disclosures. Financial statements often include notes explaining numbers on the balance sheet. These notes provide insights into accounting methods, potential risks, and additional details about assets or liabilities. Reading them helps gain a clearer understanding of financial data. A balance sheet is a powerful financial tool that reveals a company's overall financial standing. By understanding key components like assets, liabilities, and equity, and using financial ratios, anyone can analyze financial health more effectively. Whether you're an investor, business owner, or finance student, mastering these basics will improve your financial decision-making skills.